You know how to get into crypto, but do you actually know how to get out? Most people actually don't, and that's actually why they lose everything in this market. We've all been there. Your portfolio explodes, you're up 2x, 5x, maybe even 10x. Then the bear market hits and those gains absolutely vanish. Today we're tackling the hardest part of crypto, knowing when, but more importantly, how to sell. Everyone always obsesses over entries, but your entry doesn't matter if you never actually take profits. I'm going to show you the exact strategy I'm using this cycle, and here's the thing. Most people will ignore this. They'll watch this video and then probably do nothing. But if you actually implement what I'm about to show you, you'll be one of the few who walks away with life-changing money instead of regret. Because profits aren't actually real until they're realized. And the market does not care about your potential gains, but your bank account cares about the real ones. So without further ado, let's get into it. First things first, the importance of profit taking. Crypto markets are wild. They're absolutely extremely volatile. Those 4-year cycles tied to Bitcoin halvings, historical data shows most people, especially newbies, round trip their investments. So here's how it goes. In the bull phase, you see massive paper gains. At peak euphoria, greed kicks in. FOMO makes you hold, thinking it'll go on forever. Then the reversal hits, you deny it's over. Bear market drops everything 70 to 90% from the top, and poof, back to the start or worse. I've seen it in 2018, 2022, and hey, we're even seeing hints of it late in 2025, early 2026. Don't be that statistic. Profit taking isn't selling out, it's smart money management. So to avoid this, you need to understand your own individual context. Everyone's different, so your exit strategy should actually match who you are. Start by deciding what type of investor you are. Are you a long-term holder, adding value over many years? Or are you a scalper, in and out for quick profits on high-risk plays? You can do both. Maybe hold BTC Core while trading alts. For example, with Bitcoin, we obsess over entries, DCAing bears, buying those dips. But for alts, it's the opposite. Get in during those market opportunities where prices are down, but always plan exits because they're way more volatile than any other asset on planet Earth. So let's actually break down what those key factors are. The first one being your investment timeline. Short-term traders, which is probably between 1 to 12 months, need to learn aggressive profit taking. Higher sells at smaller gains. Focus on preserving capitals. Use percentage-based strategies. For medium-term holders, this might be 1 to 3 years. You can balance it. You can withstand that volatility. You can mix in taking profits with holding, but also scaling out. For long-term investors, which is many of us here, that's 3+ years. And you can be more conservative. You might focus on major cycle peaks, dollar cost averaging out slowly, selling small portions. As cyclical altcoin investors, most of us fall into medium to long-term. That's me. In bears, hodl, sell at peaks. A simple balanced approach works. Dollar cost average during downturns, then eye those cycle highs for exits. Next, have your financial goals. Are you paying off debt? Well, if you are, be aggressive, be lower risk, secure those gains much faster. For wealth building, balance securing profits with always having some exposure. You're looking to retire? Well, be conservative, preserve capital, regular taking profits, and tailor it. Of course, risk tolerance is huge. It's one of the biggest things. Once again, if you're conservative, taking early profit at 25 to 50% gains is fine. Sell it in larger amounts. Prioritize preservation. If you're moderate, we might have 50 to 200% targets. Even selling some, keeping some for exposure. If you're aggressive like me, 200% on spot holdings, higher risk for bigger rewards. On leverage trades, I hunt shorter gains, getting in and out of the market fast and utilizing that chop and volatility that we see for mostly year-round in cryptocurrency. Of course, portfolio size matters too. If you've got a small account, such as less than $10,000, be aggressive for percentage pops, ignore tiny profits, and of course, watch fees. You don't want that to be eating into your small portfolio size. If you're medium, let's just say $10,000 to $100,000, you can diversify your strategies. You've got more flexibility. Here you might mix in long-term holdings with DeFi strategies and trading strategies. Then of course, as a large holder, let's just say you've got over $100,000 in crypto, be conservative, preserve, consider the market impact, macroeconomic cycles, use multiple exchanges, multiple wallets and more. Finally, market knowledge. If you're a beginner, let's just keep it simple. Fixed percentages, automated selling orders, clear exit. Well, if you're experienced like us, you can layer in deep fundamental analysis, technical analysis. You can have dynamic tweets, be taking profits at support and resistance, and utilizing things like Fibonacci retracements and extensions to get in and out of the market. But of course, preventing that round trip starts with clear objectives. Define your profit targets, write your own goals, plan your actions, and review this regularly. Psychologically, accept you'll never absolutely be able to sell the top. Literally, not one single person in this market does. Profits are never actually real until they're realized. And that's actually a trap in crypto. Prep for those FOMOs in those rallies, plan reversals when there's absolutely peak euphoria and greed. What you can do, you can implement this with tools, such as price alerts on exchanges or TradingView, which is something I do. You can use free-to-use portfolio trackers such as CoinMarketCap or CoinGecko to constantly review your portfolio and stick to plans. Use all those automation tools out there, such as limit orders, buy orders, and more to get in and out of the market. Common pitfalls: emotional decisions, mid-cycle strategy swaps, ignoring cycles, bull market overconfidence. How do you avoid this? You avoid this by staying disciplined.
Just quickly, if you're ready to take your results to the next level, my team at Imperial Wealth Crypto can help. Inside our Crypto Academy, you'll get access to my personal portfolio, strategies, real-time market insights, and the exact plays my team and I use to stay ahead. With our team of analysts monitoring the markets 24/7, we've helped investors catch moves like a coin that's done a 5x in 4 days. If you're serious about accelerating your wealth, click the link below to book in a call with my team of experts and see how we can help. Now, back to the episode.
Now let's actually get into some of these strategies I've mentioned in details. These are tailored options, so you can absolutely pick what fits you best. First, the percentage-based strategy. Set percentage-based targets from entry. For instance, you could sell 20% of your holdings at a 25% gain, 30% at a 50% gain, and another 30% at 100%, keeping that 20% long-term bag. What does this do? It locks profits systematically, maintaining upside. However, are there some drawbacks? You might sell early in the big runs, which obviously requires some pretty good discipline. What is this great for? It's great for risk-averse folks, but not me. I'd miss BTC's massive cycles by probably selling too soon and too aggressively taking profits when I know that cycles are going to lengthen and there's better times to take profits. What's another option you can do? You can dollar cost average out. What does this mean? You can actually do this periodically, such as selling 10% weekly and monthly until you've got desired size out of the market. You can use fixed dates, automated sell orders, and what this does is it ignores all the short-term chop and short-term volatility that affects most investors. What are the benefits here? It's emotion-free. You've got out good average prices, both in and out of the market. It's great in a sideways market. What it may miss is missing trends. Of course, you're just exiting the market, dollar cost averaging out, without actually knowing, if you're doing this periodically, that it's at a time where the market's going to lengthen and the bull cycle could extend. Of course, they're scaling out. You could sell 10% at a 2x, 20% at a 3x, 30% at a 4x, and then 20% at a 5x. And once again, holding another 20% for the long term. What does this do? It captures huge gains and uptrends and projects reversals. The only downside is it's probably a bit complex to track, hence why you should be using things such as TradingView for alerts. Of course, one of my favorites is actually utilizing technical analysis such as Fibonacci strategies. For retracements, that is entering the market, you can use Fibonacci retracement levels such as the 23.6, 38.2%, up to the 88.6% from major lows to major highs. For extensions, major highs to major lows with profit-taking strategies such as taking partial profits at the 1.236, major at the golden ratio, which is the 1.618, all the way up to the 3.618 in explosions. You can use either retracements or extensions in confluence with other technical analysis, indicators, and on-chain analysis to nail your profit taking. Another strategy is the initial investment recovery. What this does is sell enough to get back your entry. For instance, when you're 100% up, sell 50% so you've got your entry back and the rest you're riding is actually risk-free. What this does is it reduces pressure. There's actually zero risk after this. You're riding the rest free. Perfect for risk-averse investors. The only drawback is, of course, if the market continues to go up, you will have a smaller future position. An implementation tip for all of these strategies is utilizing limit orders on centralized exchanges to avoid slippage and to have your profit-taking orders in place, which you can utilize with alerts for targets, and in times of cycle positions where taking profits is highly desirable. Need help? Feel free to ask us. Now, the strategy that I'm employing, this is called the macro top exit strategy. What this does is it uses Bitcoin cycles, which may not be as important, but mixing these with a fundamental and technical mix that takes into account liquidity cycles, monetary and fiscal policy, and deeper macroeconomics. Instead of piecemeal takes, wait for actual top signs to come in and exit most at once. Now, what are some of the core indicators that I'm going to be using to take profits this cycle? One of them actually is time-based, but not so much on the halving anymore. Of course, historically, the most best performing years have been 2013, 2017, and 2021, which has historically been 12 to 18 months post-halving. Of course, this cycle has been completely different where we made an all-time high before the halving, and in actually the year after the halving, which was 2025, we had pretty poor price performance. So what I'm doing is to align with the macro and liquidity cycle more so than the Bitcoin cycle and utilize the top of that to take my profits. Of course, when we get to the peak of that cycle, there should be a lot of psychological drama going on. What do I mean by this? Extreme media euphoria, mainstream FOMO where that taxi or Uber driver is chatting to you about crypto and where everyone just starts to get those this time is different vibes. Everyone becomes an expert. Everyone's got those wild price predictions. You definitely need to watch out for this when the timing is right. Of course, me being me, I use a lot of technical analysis. So when I see those charts going parabolic, we're seeing 5 to 15% daily gains, volume is spiking like crazy, RSI is at absolutely high levels, we're way above our average moving averages, there's fib extensions with confluence being hit, you know I'm going to be taking profits when these levels are going to be hit. And of course, what can we use in confluence with that technical analysis? It's that on-chain analysis. When there's mining extremes, slowing withdrawals, long-term holders are beginning to sell, new addresses are spiking, and on-chain indicators such as the Pi cycle indicator, the Pure multiple, the NUPL and MVRV are at highs, I will definitely be selling a lot of my cryptocurrency. And of course, as I mentioned at the start, do not underestimate how much macroeconomics is impacting cryptocurrency these days. You can be tracking things like the USD through the DXY, look into the stock markets, the bond markets, and of course, the most important in my mind, which is global liquidity. This is absolutely the most important thing you must be looking at in this day and age, particularly this cycle. Having a thorough understanding of the macroeconomic landscape, particularly that fiscal and monetary policy, will put you in good stead for understanding when the financial markets, not just Bitcoin, are most likely to cool off and you should be taking heaps and heaps of profits. So how do we put this into execution? Well, at those first warnings, I'm going to be reducing by at least 25 to 33%. When there's clear tops coming in, such as the number of those technical indicators being hit, the charts are hitting highs, RSI is exploding, that Uber driver's talking to you, maybe reduce it by another 33 to 50%. And then amongst confirmation that we are actually entering a bear market, of course you can exit the rest if you want to, or keep a little bit of exposure in case we go back up. What are actually the advantages of this? Well, it maximizes gains in bulls, it avoids selling too early, and of course a few risks are you may miss the top, but this is far, far, far better than what 99% of the market does, and that's round trip. In conclusion, profit taking is personal. It's tailored to your own contextual financial situation, your own goals, and your own risks. So what do you need to do? You need to understand yourself. You need to choose the right strategies, the right discipline. You need to review, and you need to adapt. There's absolutely no perfect method to taking profit, but one that aligns, matches your tolerance, and that you can execute consistently, that flexes and protects your drawdowns is going to be best for you. So don't let that greed or fear win. Secure those profits this cycle and be a winner where most aren't.